Joining us now is Joseph Balestrino. He's a fixed income strategist with Federated Investors, and he's joining us from Pittsburgh. So, Joe, how do you read what we have seen in terms of the bond market and how it reflects on Geithner?
Yeah, Julie, you framed it pretty well. I think the optimist would say it's confidence in the leadership that's being portrayed. I tend to think in much more simple terms. Low yields tend to signify anxiety. Rising yields seem to say the economy's back on its feet and loan demand is up, and we're a long way from that. So I take the feeling that anxiety still reigns and yields are down as the ultimate safe haven investment.
Do you think, though, that what we have seen in the Treasury market in terms of the price and yield action plays into the Treasury Department plan? Is this what they want to see right now?
Not sure exactly that it's what they want to see. It's kind of the secondary outcome's not a bad one, in as much as they have accelerated, and that's, putting it politely, the amount of borrowing that we're doing at the federal level. The all-in cost isn't so bad with yields at record low levels. They would like to see market rates go up, again, signifying that you have some velocity through the system. They have not accomplished that at this point. The markets are open and doing fine, but money's not flowing through the economy just as of yet.
Joe, on September 5th, Treasury Secretary Geithner was at the conclusion of that G20 meeting with the finance ministers and central bankers in London, and he released a statement which read in part, "We must lay a foundation for more balanced and sustainable pattern of future growth." His actions right now, is he laying that foundation?
I think the foundation has been laid down. It's a matter of giving it time to work. Unfortunately, I think to give it time to work means to spend more money. So most of the stimulus package that's now been in place for a year or so, most of the money to be spent is just that. It's to be spent in the future, and that's all part of it.
And Joe, might I ask, because you told Julie what the optimist would say, is that what the pessimist would say? Here we go again, spending more money?
Well, I think the pessimist would say that partially. The pessimist would say this is not a self-sustaining economy. While it's doing okay and most of the indicators are moving in the right direction, this is a very weak absolute economy. And arguably, if you remove the stimulus, it just goes right backwards again.
Well, and when you talk about the auctions that have been going on in the debt market that has propelled this increase in prices for treasuries, how long do you expect this to be able to go on and for there to be investor demand? This is something we've been talking with so many fixed income strategists about.
And quite honestly, I'm surprised it's gone on this long. With the amount of money, we used to worry about a quarterly auction cycle. Now it's every other week, and it's tens of billions in each phase. It's tough. I think part of what's going on is the currencies being devalued. We should expect to see that. But along with that, a deficit usually has a cost, and part of that cost is not just the currency, but the cost of debt. The interest rates have to go up over the next couple of years.
And something else we've also been asking a lot of folks, and got to get you to weigh in on it, what's going to be the catalyst that's going to change this direction in the Treasury market?
I think it's overall economic growth outside of the United States. What we're seeing develop's probably not a great word, in the emerging economies for the first time. There's a consumer base developing. In essence, they're eating their own cooking for the first time in history. They used to be export economies. Now they're actually using some of their own commodities in manufacturing, and to the extent that grows, and we think it does, there should be less of a demand for U.S. assets.
But Joe, low yields, they're a reflection of monetary policy, right? Not Treasury policy.
It's low yields at the very short end of the curve, and we've bernanke a little surprised that Bernanke and company sticking to the extended period language.
Why?
In essence, I kind of agree with the article that appeared, I think, in Barron's about 6 weeks ago that said, why not take Fed funds to 2%, show some confidence, give some savers a break by at least giving them a little bit of return, probably at the margin gives us a little discretionary income that the retiree, for example, does not have today. So low yields, I think, is part of the reason why the TIPS break-even spreads have gone up. If you're going to keep rates at zero for the foreseeable future, inflation has to become a bigger concern. So it is affecting both ends of the market. Well,
and our Brian Luke earlier in the show talked about an economist who said take the Fed funds rate to 2%, just as you were talking about, also to help sort of, this is counterintuitive, but to sort of help banks want to go out there and lend more money at potentially a higher profit. Do you think that, I mean, not that the Fed is doing that tomorrow, but do you think that's an idea that could work?
It would be nice to see that. That's the one missing piece of the puzzle so far is just implied in your question, Julie. Banks have not been lending money. They've been recapitalized. Part of the reason why yields are so low is excessive demand. Part of that demand is actually not just the consumer savings rate going up, but banks have been buying treasuries. So a steep yield curve is a banker's delight, presumably because they lend money into a steep yield curve. In this case, they've not been doing it. They've simply been buying treasuries.
All right.
Joe Balestrino, thanks a lot for joining us. Appreciate it.